Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 446. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
And life insurance accessories.
And the oldest, I think. I'm just going to declare
Sure,
it.
why not?
We're going to make that statement until someone comes and proves us wrong.
Yeah.
I feel like we just did this.
Well, it's because we did. Just a few days ago. Here's to hoping the internet cooperates today.
Yes. That would be good. Hey, I have a question.
What's that?
What is the rate of return of indexed universal life insurance?
Well, sir, that depends on... That depends. Depends on a lot of things.
It does?
What index are we talking about? What cap rate? How long are we talking?
Okay, what's the 40-year average rate of return of indexed universal life insurance?
In that case, I have absolutely no idea. If you said 29, I could nail it, but 40 outside of the... No, I'm kidding. I have no idea.
Always good.
Well,
always good.
There is no average is the real answer, but
average is a complicated consideration.
Yep.
So because we like doing lots of pointless math on Friday evening, we went back and I'm the one who's boring. Went and figured out what the 40-year rate of return probabilities are with indexed universal life insurance, given certain parameters.
Yep.
Looking at cap rates and the S&P 500 is our driving index to suss out what expectations should be, but also to sort of give some guidance on how various elements associated with indexed products affect the expected rate of return of an indexed universal life insurance policy. Because there's an array of options, right? Like somebody's got a 10% cap, someone's got a 12% cap, someone's got 11% cap. What's the difference? Somebody has a floor, somebody doesn't have a floor. How important is the floor? Mm-hmm. But also looking at this from the standpoint of lots of people will ask you what's the average rate of return, and you can give them an answer, but that answer means nothing.
Right.
Because average is just a descriptive statement. This is what it was. We can't really make any inferences from that. We've discussed this in the past. Instead, we need to understand what the probability of hitting certain rates of return are. Mm-hmm. And once we know that, we can start to make some forward projections about what might actually happen if you buy indexed universal life insurance.
Right.
So the answer is never a singular answer. It's always the likelihood of this is that and that is this. And you just have to learn to live with that if you want to make accurate projections moving forward. Mm-hmm. So we're here today to try and give everyone a good understanding of what expectations should be and also what various changes or different options have as an overall impact on what we would expect in terms of results.
Right.
We should probably do a little background on how this is modeled to arrive at the answers that we have.
We're about to throw a lot of numbers at you through audio, so
this is what we do best. So, we're going to use, as I mentioned earlier, the S&P 500 because that's just the one with the most data. Yes, there are lots of indexed universal life products that exist today with more than just an S&P 500 index, and we can speak to that a little later. But for right now, we're gonna run this analysis with the S&P 500. We're going to use 40 years as our time frame. So it's the 40-year result.
Right.
And in that, we're going to use historical S&P 500 data, and we're going to use rolling years as our observations. So a 40-year period, and then we roll everything forward 1 year and use that 40-year period. We roll everything forward another year and use that 40-year period. That gives us the observation so that we can count probabilities.
Right.
And we're going to use data from 1930 through 2024. The S&P 500 that exists today didn't exist in 1930, but there was a comparable index put together by Standard & Poor that is the acceptable substitution until we get to the late 50s when the S&P 500 that we know of today came into formation.
Right.
there's that. We're looking at an array of different cap rates and floor situations, again, to see how changing those differs. And all of the numbers that we're going to talk about today, we're going to do this a little differently than I think a lot of people tend to approach this. We're going to talk about net terms. So this is the real rate of return that we expect to materialize. This is not just the average index credit.
Right.
Because the average index credit's pretty meaningless when it comes to what we expect to grow in terms of account balance. This is taking into account fees that would be associated with indexed universal life insurance. I've actually doubled our typical observation of what fees generally work out to lifetime-wise. And I did that as a contingency for things changing, like cap rates and such. Things may not be as favorable in the future. So if we double the fees, that gives us some contingency to fall back on.
Right.
So are we ready to unleash a shotgun of data on everyone?
Yeah, go for it.
The excitement. I'm trying to build the excitement. I'm doing a bad job. So we're going to start 11.5% cap rate, 1% floor. The average, which is the useless number, that comes out to 7.25% just for all the observations. But the probability of actually hitting certain numbers. So let's use 7%. Probability of 7% net rate of return over a 40-year period comes out to about 86%.
Right.
Probability of 7.25 is 55%, and probability of 7.5 is about 16%. Standard deviation, which I know is now we're getting a little more complicated, but I'm going somewhere with this, 0.23. So not a whole lot of variability to the data. Stays pretty consistent time over time.
Yep.
Now, if we have to make decisions about things we want to sacrifice, because sometimes we lose certain guarantees. So I want to remind everybody that the numbers that we just rolled through, where we have an 86% chance of a 7% net rate of return accumulating in an indexed universal life policy, assuming an 11.5% cap rate and a 1% guaranteed floor. So best you can do in any year is 11.5. Worst you could do is 1%.
Right.
Sometimes we find ourselves in situations where we have to make a decision. We're sacrificing between that kind of guaranteed lower end versus the upper end. So if we remove the floor, now our worst possible scenario is 0. If we do that, the average comes out to 7%. The 7% rate of return drops to a 57% probability. Right. Good news is 6.5% is 98%. So it's very, very, very likely we'd end up with a 6.5% rate of return on an indexed universal life policy under this situation. So 11.5% cap, 0 floor. Mm-hmm. Obviously, all of those other percentages, they drop pretty significantly. 7.25 drops to 20%, 7.5, 2% probability of materializing. Now, interestingly, standard deviation doesn't change that much, 0.27.
Right. Very low still.
Not a lot of variability, which means our certainty that, yep, it's going to do worse, but we're also pretty sure we know where it's going to fall, that remains high.
Yep.
So what happens if we want to keep the floor at 1%, but in order to get that, we got to sacrifice the cap. So we're going to lose 1% on the cap. So now 10.5% cap, 1% floor. Well, our average is going to fall to 6.72% for whatever that's worth. Our basically 100% probability situation is 6.25. So not a huge difference in terms of what we expect, but it's going to change. It's going to go down. 7% probability drops like a rock to 11%. 7.25 to 2%, 7.5% is just not going to happen in that situation.
Right.
Standard deviation 0.22. So again, we are not seeing a massive change in variability. In fact, it's slightly improved when we gain our 1% floor, but sacrifice the up end, which kind of follows with the logic behind what a floor is supposed to produce.
Right.
So, what we can see from this is, even though floors are nice, if they come at the cost of a higher cap, we should give up the floor and take a higher cap.
Right. They don't have that much of an impact
Mhm.
the floor.
The odds are in our favor that our results are going to be better.
Right.
When we have to sacrifice between higher cap and the establishment of some sort of floor.
Yep.
Now, to mix things up a little bit, we wanted to look at what happens when we start using an assumption that is much more popular these days with indexed universal life products as they're being rolled out in new iterations. We're eliminating the cap, and we're going to use participation rates and spreads to see what that does to the overall performance of the indexed universal life insurance policy. So let's start 70% participation rate, 0 floor. So worst case scenario, 0. Best case scenario, 70% of whatever the S&P 500 does. Under that situation, average comes out to 9.55%. There's a 96% probability that our real rate of return will be at least 9%. An 88% probability it'll be at least 9.25%. And a 54% probability it'll be 9.5%. The pause was because my notes were wrong.
I was like 7.5.
Standard deviation.
I would think if 9 was 96, 7.5 would be significantly higher. Logic would say.
Sometimes you type and you hit the wrong key. Standard deviation does tick up a little bit to 0.32.
Yeah.
So more volatility here, but also a monstrously higher likely rate of return.
Yeah.
In fact, a
It's
monstrously higher
actually.
certain rate of return, actually.
Yeah. Yeah.
So much improved performance with slightly more volatility.
Right.
Now, if we go no participation rate but spread situation, what we find ourselves developing 8.32% average. So there's that number. 95%.
Which basically this just means if the S&P does 18%, you get 10.
Yeah. So that's right. I should probably explain a spread. I actually probably explain participation, although I kind of did. The participation is just percentage of, so 70% of the S&P 500 performance. 8% spread means whatever the S&P 500 is minus 8%.
Right.
So as you already said, if it's up 18%, you get 10. So this though comes with the possibility that the spread could drive the index earnings to 0, even if the S&P 500 is positive.
Right.
Because if the S&P 500 is up 5% for the year, 5 minus 8 is actually a negative number, but since the index product can't pay you negative interest, it just turns into 0.
Yep.
That's the result in that situation. So, probability of at least a 7.75% real rate of return over 40 years, 95%. Probability of at least 8%, 76%. Probability of 8.25%, 55%. Standard deviation, highest yet at 0.42. So spreads do add a significant amount of higher volatility, again, most likely because of that kind of harsh adjustment whenever the real results from the S&P 500 are under the spread.
Right. Yeah. If the S&P only does 7%, then you get 0.
Mm-hmm.
Yeah.
Mm-hmm. For what it's worth, real stock market results. So again, using the S&P 500, 40-year average comes out to right around 11%. There is a 100% probability of at least 9%, 57% probability of at least 11%.
Right.
Standard deviation 0.76. Many multiples higher than the indexed universal life products produce.
Yeah. About 3 times higher than the lowest standard deviation in IUL.
Right. And like double what the best performing result is, which is the 70% participation rate.
Yep.
Situation. We have made the point numerous times in the past that indexed universal life insurance produces a enhanced rate of return for a fixed style savings. I'm the one who can say investment in air quotes. So that exists, and it does it with a significantly less amount of volatility.
Right. As proven in the numbers.
And here it is yet again.
Yeah.
So, look, as has been our long-standing statement, we're not using indexed universal life insurance to beat the market.
Right.
The people who are telling you it's the only can go up asset that gives you what the market does, but it doesn't participate in the falls of the market, they're idiots. They're lying to you. Index universal life insurance is another fixed strategy. Yes, it follows something like the S&P 500. That does not mean it's stock market exposure necessarily. The fact that it doesn't go beyond zero is a significant hedge. But it does have the ability to produce some pretty substantial payments and interest in good market years, especially when we have non-capped options available.
Yeah, like the participation rate or the spread.
Yep, evidenced by those non-capped features.
Yep.
Now, 9-ish% as a real rate of return on a fixed product, that's a noteworthy accomplishment.
It is.
8% and 7% are noteworthy accomplishments.
Right. Yeah.
And keep in mind, I said these are real rate of return calculations. These are not index credits, which means the index credits are actually somewhat higher than this. They have to be.
Right.
Because fees have to get deducted from cash.
Right.
So with these sorts of indexing parameters, and these indexing parameters exist, and there are some that are better than what I've modeled.
Yep.
We have insurance products, fixed insurance products, that can deliver a substantial amount of accumulation. It's not stock market accumulation. I still think you're going to do better in the stock market. But the one thing that the indexed universal life insurance does not contend with is the timing of bad years.
It doesn't have to.
So even though you could be doing really, really, really well in the market, you are one bad month or year away from a dramatic revision downward.
Yeah.
And that could have a substantial impact on what you do with your money in the moment that you want to do something with your money.
Mm-hmm.
Indexed universal life insurance doesn't contend with any of that.
Right.
Because if it's a bad year, it's simply a zero index credit.
Right.
Even if you're taking money out of the indexed universal life insurance product, that's not going to be a substantial impact on your future ability to use the cash value buildup for income.
Right.
It's just not.
Yep. That is true.
There are a number of things that could go badly if you need to start taking income, or you've begun taking income from something in the market and there's a bad year. And that's a well-known aspect of market investing, and it's a key driver behind the push for diversification among financial advisors.
Yes.
The idea here is we need to not be overly stock market exposed because we need to hedge risk and we need to minimize the impact of a really bad year.
Yep.
The paradigm kind of became splitting it up with bonds. There is some criticism that bonds may not be the right choice in all circumstances because bonds could decline in value, and that would exacerbate the issue. But in general, bonds have been a reasonably good substitution to minimize some risk.
Yep.
But when we do that, our rate of return expectations are going to change.
Mm-hmm.
A 60-40 stock to bonds portfolio is not going to produce an 11% on average and a 100% certainty of 9% or more rate of return over a 40-year period.
Right.
That's just not going to do that because the bond component won't contribute that much to the rate of return.
Right.
And the stock performance will be handicapped by the bond exposure.
Mm-hmm.
I'm not saying that 60-40 will fall below what indexed universal life insurance can do. I don't know that because we haven't done the analysis on that. But what I am going to point out to you is that if 11% is the average and 9% is the, like, we're very confident in that number on the S&P 500. And we are pretty highly confident of that number on certain indexed universal life insurance products. Not all, but some. That starts to show us that indexed universal life insurance is a very, very adequate substitution for the de-risk strategy.
Right.
And think about it.
We're not trying to present this as you should do this or that.
Yes, no.
We're saying, look at how IUL complements the other things that you're doing.
Think about it in this context. If some indexed universal life insurance products have an ability to get much closer to stock market-like results, again, we're not saying they're going to beat them, but they get closer to them. if you used indexed universal life insurance as the de-risking component of your portfolio instead of bonds, your overall rate of return can only go one direction, up. Because indexed universal life insurance is tracking what stocks are more performing at than bonds. Then you've got a low risk asset that's doing what bonds would deliver while giving you a rate of return that is closer to, not exactly matching, but closer to what stocks might perform at.
Mm-hmm.
That gets you more buying power, capacity to use the dollars than would a traditional 60-40 stock bond portfolio.
Right. Can we talk about some of the assumptions that were made in terms of the various index types and where, I guess what I'm asking is, can we spend a couple minutes poking holes in what we what was put together?
Sure.
A couple things that come to mind for me are, a 70%, like I'm particularly going to focus on the participation rate and the spread.
Yep.
We have seen over the last few years an inordinate amount of volatility in spreads and in participation rates.
Mm-hmm.
So that is all we can do, I guess, in an assumption scenario like this is sort of use average numbers, but those numbers will change over a 40-year period. Mm-hmm. Most certainly you'll have different participation rates and different spread rates. For that matter, different cap rates as well.
Yep.
So
you're saying, that we could be wrong about those 70% figures, 70% participation rate figures, because if it goes down, that is going to change the actual results.
Yeah.
Because if it, for example, goes to 65%, then we're not getting 70% of whatever the S&P 500 is anymore.
Right.
And that is going to alter our results.
Yeah.
By bringing them down.
Yep.
In part, it's trying to control for that with the higher expense assumptions. But you are correct that the participation rate can move. And for sure, within the industry, we know that products that use the S&P 500, for example, as the driving index, I'll say, and use a participation rate or even a cap rate, those tend to be more volatile than some of the more blended index options that exist.
Yeah.
And the reason for that is really, really simple. There is far less competition buying up derivatives for proprietary blended indices.
Right.
Than would be the case.
That's why they exist.
Yeah. Would be the case of people buying up derivatives for the S&P 500. There's everybody who's in the indexed business has an indexed account, an S&P 500 account. So there's lots and lots of people trying to pile into S&P derivatives, which causes a pricing increase, which is less favorable to keeping a cap rate high or a participation rate high.
Yeah.
So that is for sure.
Yep. And some of it also depends on, we have seen, and this is I guess somewhat of a black box component, if there is such a thing in IUL, and that is how various companies manage that. The options pricing, interest rate changes. We've seen some companies be much more volatile than others, is my point.
Mm-hmm. A lot of companies do indeed become more volatile because they tend to rely on third parties to create the indexing aspect of it, the purchase of the derivatives, for example. So that puts them more at the mercy of whatever that third party provider decides is going to be the parameters that allow them to create the cap rate or the participation rate. There is a very, very, very limited number of companies out there that do it themselves.
Right.
And the data mostly shows us that the ones that do it themselves are in general the ones that have higher participation rates or higher cap rates.
Yep.
They're squeezing out a middleman, so they have a little more margin to work with.
Yep. A little more pricing control.
Mm-hmm. You asked, I did the math. So what happens if our participation rate falls from 70% to 60%? 100, well, near 100%, 95% probability of a 7.75% rate of return.
Yep.
Average is 8.15 at that point. So it does bring it down. It brings it down a good bit.
But still well within acceptable range for a fixed product.
Yep, it does.
Yeah, I wasn't trying to sell anything short, by the way. I just always am like, let's make sure that people understand these numbers are not set in stone anywhere. So
no,
they can and will change. They can also go the other direction, by the way.
They can, and they have.
They become more favorable or less favorable.
I'm aware of it.
Both directions.
I'm aware of at least one using an S&P account with a participation rate that went down for a few months this year and has come back up.
Yep.
So, it certainly does move around, and we haven't spoken a lot about. I referenced earlier in this episode today that there are also index accounts that aren't just exclusively S&P 500.
Right.
And they're a bit harder to model with this sort of analysis because we don't have all of the data that would be necessary for the index accounts. Not at least without spending hours and hours and hours and hours trying to replicate their historical results. To get enough data to sort of make these inferences on probabilities.
Mm-hmm.
So we're stuck a little bit there. In general, those accounts tend to work more as a hedge against volatility even further, in the sense that there may be a switching from stocks to bonds or stocks to cash or something like that, in an effort to blunt the negative impacts of volatility.
Yep.
And give you kind of diversified exposure to different broader index options in the market. So it's not just stocks.
Mm-hmm.
We've seen them work. We've seen them provide interesting results. Some of those style accounts are up pretty considerably, especially over the past couple of months, because we've seen interest rates dropping. So anytime you have fixed or bond style exposure and you see interest rates dropping, that does really, really good things for value in terms of appreciation of an index heavily concentrated in bonds, for example.
Right.
I would say there are more years that stock style index accounts are up more than those are.
Right.
But they do work in terms of smoothing the overall volatility of things. I don't know how significant it is to do that inside index universal life insurance, quite frankly, but it exists. And the other advantage that we already kind of hinted at that those do bring to the table is some degree of proprietary nature, which gives insurance companies much more leverage over pricing, which does allow for significantly higher participation rates, many times higher than 100%. So it's actually the movement in the index times, let's say 1.5 or something like that.
Right.
Which does start to draw it closer to the results of something S&P centric.
Exactly.
So again, expected rate of return of index universal life insurance is enhanced over things like whole life insurance. We've been very public about that. There is more volatility to it. I think that the trade-off of higher rate of return versus the volatility does tend to, in some situations, swing things in IUL's favor.
Yeah.
I know from experience, there are still some circumstances when it comes to putting policies together, whole life insurance will still absolutely be the right answer.
Yeah.
So that does not mean index universal life insurance is the universal winner. A lot of that
depends on age and time frame.
Yep.
That's kind of the key components that I've seen over and over, the pattern over the years.
Mm-hmm.
When we look at them side by side for a client or potential client scenario.
Yep.
If someone's planned to fund it on a limited basis and they are, I hate to name an age, let's say they're older than 60.
Yeah.
it may not work out as well as a whole life policy in that scenario.
Yep. The advantage starts to decline.
Yep.
So it doesn't become as easy an answer.
Mm-hmm.
So that's just the way that works out. But given the overall lack of volatility associated with index universal life insurance, its safety profile, and its rate of return, it does make a fantastic option as a low-risk component to the portfolio to complement your stock allocations. And it does it in a way that has a much higher rate of return expectation than bonds will have.
Right.
That's our fundamental reason for liking it.
Exactly. Okay.
That's it for today.
Yay.
So I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.